If you're looking to buy Senseonics stock, then keep watching because we're going to look at the company's recent news, how the market is treating it, and what are the technicals telling us. We're also going to try to come up with the best trading approach given the current circumstances. As the market remains very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Senseonics has been trading slightly lower compared to where it has been just a month ago, from around 56 cents all the way down to 48, eventually recovering back somewhat to a relative high at 54 cents. The downward tendency has been maintained over time, but definitely at a slower and more consistent basis compared to how things were back in August this year, when the price dipped by more than 40% over the course of just a mere few weeks. It seems like the market has been much more interested in the stock in the past, and the capital has now flowed in and out of it once again, looking for the next stock with bigger opportunities, or in this case, volatilities. Senseonics has been trying to reach back to where it was in the heydays of the tech stock boom, but the current wave seems to be very much against it. Nevertheless, the current price action seems to be solidifying the support region near the 50 cents level, and we can expect the room upward is certainly going to be bigger than the room downward. With that being said, let's take a look at the technicals. The trading volume of Senseonics has been recently around 1.2 million shares versus the average volume of 1.8 million shares. Over the previous 52 weeks period, the price fluctuated between 48 cents and $1.29. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited too. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large as well. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap for Senseonics is around $283 million versus the enterprise value of $206 million. As we compare the current price to the historical price fluctuations, the stock is 14% higher than the 1-month low, 14% higher than the 3-month low, and 14% higher than the 52 weeks low. On the options market, which often gives a hint on the market sentiment on where the stock price is probably going to head next, the implied volatility is 113% versus a historical volatility of 56%. The put-call volume ratio is currently at 0%. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 865 contracts a day versus the 30-day average of 255 contracts. Regarding the open interest, the most recent volume of open interest is 100,000 contracts versus the 30-day average of 103,000 contracts. Regarding the shareholder structure, institutional shareholders hold about 15% of the outstanding shares. The biggest shareholders include Vanguard, State Street, and BlackRock. It's always best to see some institutional participation when holding a stock long term, because it offers a layer of stability and token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by retails. The current short interest is around 10% of the total float, 60% of which comes out of the dark pools. Typically, if the short interest is around 15% or more, there might be an argument that there is institutional position taken to short the stock and that there might be a short squeeze that could occur in the future. So, right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. Overall, I believe that Senseonics deserves to be on our shortlist of the stocks to buy or to buy in the future, and that its price action should be monitored closely for any opportunity to get higher. It may be able to find a place in our portfolio as a speculative position to short and medium term trading. I would recommend to commit between 1 to 3% of your portfolio in this stock, and would also recommend to split the allocation in batches of 20% at a time over 3 to 6 months so that you can purchase more if it retraces.